Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
This week, we're going to have a look at what the market is pricing in with regards to the negotiations between the US and Iran. We'll have a look at some concerning Chinese data that suggests a soft patch ahead for commodity prices. We'll have a look at the hike from the Bank of Japan. And finally, we'll have a look at inflation in SA. We're going to start off with what the market expects with regards to the negotiations between the US and Iran. The 60-day negotiation period has got off to a bumpy start. There was news over the weekend that negotiations were off and then they were on again. At the time of recording now, US futures are down about 30 basis points or so, and crude in Japan about 1%. And just taking a step back, the market in general is expecting peace already, and we can see it in a number of different ways, most obviously through inflation expectations that are embedded in the bond market. For example, if you look at what's priced in for inflation over the next 2 years in the US bond market, at the height of the conflict, that number was sitting at about 3.5%. It's now sitting at just a bit above 2%. And if you look at inflation that's priced in for the next 5 years and 10 years, it's also sitting at just a bit above 2%, which are pretty normal numbers. So in effect, the market already is pricing in a normal inflationary environment. And by inference, that implies a normal crude price, which implies peace in the Middle East. And there's a little margin of safety here. If it turns out that the conflict resumes, we can expect these inflation expectations to go back up again. But again, at this point, the market is not pricing in the conflict to persist. In fact, the market, it would appear, is pricing in peace with a very high probability. At the same time, the market is still expecting a hike from the Fed. And this is an important point, and we have touched on this over the past few months. There's two inflation issues in the US. The first was driven by higher energy prices, where the market thinks it's likely to be transitory. And in a relatively short period of time, the market expects that that component will dissipate completely. But there's another component, and that is core inflation, which is driven by prices not related to either energy or food. And core inflation in the US remains pretty sticky at levels that are uncomfortable for the Fed. We saw Walsh's first meeting as chair last week, and in that meeting, he reiterated the Fed's commitment to ensuring that inflation gets to the 2% target. And the inference that the market took from is that there's a very high likelihood of a hike from the Fed by year end. In fact, post that meeting, the market is pricing in about a 90% chance that the Fed will hike by year end. And it's an important point. Even should there be peace in the Middle East and crude prices normalize and headline inflation comes down, the issue for the Fed is that core inflation in the US is remaining sticky. And at the same time, there are signs that the US economy is recovering, if not resurging. And you've got an environment now where growth is looking like it's going to be quite strong and core inflation is high. That is the sort of environment where a central bank would normally hike. So peace in the Middle East doesn't necessarily rule out a hike from the Fed by year end. Switching to China, there's been some pretty weak Chinese economic data that's recently come out. We have flagged over the past few months that the key leading indicator for the Chinese economy, a series known as total social finance, has been flagging that the Chinese economy is likely to enter into some form of a soft patch within the next few months. And it looks like that soft patch has now arrived. If you look at retail sales as an example, retail sales in China are actually now down year on year. Industrial production is still up, but it's running at close to the lowest rate that we've seen in the past 3 years as well. And if you look at a few other indicators, and we'll just touch on one, house prices as an example, house prices are down again. They've been down for 36 months in a row. And gross fixed capital formation in China was actually down year on year last year as well. So it all points to a slowdown in domestic demand in China. And there has been this drive to encourage domestic demand so the Chinese economy gets away from sort of old school Chinese growth, which is heavily reliant on exports, and try to encourage more domestic orientated demand. But that doesn't appear to have worked so far. And in the interim, it looks like we should be penciling in some pretty weak data coming from China over the next few months. And with that, there's increased concern around the near-term trajectory for commodity prices. And we just need to bear that in the back of our minds. There is space for stimulus in China. Inflation is still low. But until that stimulus is announced or effected, it is likely to be the case that we're going to see some pretty weak numbers out of China. And again, that does raise the prospect of a soft patch for commodities, just like there's a soft patch for Chinese growth. Switching to Japan, last week we saw a hike from the Bank of Japan. It was signaled well in advance, and as a result, we didn't see any outsized moves in market. Normally, in the event that there's a hike from the BOJ, you would expect that to be associated with yen strength. We haven't really seen that. The yen is still just a bit above 160 to the dollar, a level that's quite clearly uncomfortable for Japanese authorities, and they've again indicated that they may well intervene to get some form of yen strength. The market does still expect one more hike from the Bank of Japan by year end, and we are seeing a narrowing of interest rates in effect between Japan and the US, and one might think that that should put some pressure on the carry trade. We should see some repatriation of funds, and that should provide support for the yen. That is our best case, along with support for the Japanese market. But in the background, there are still rising concerns around the fiscal position in Japan. There's now been a tax cut on consumption tax for food and beverages, as an example, that puts further fiscal strain on the Japanese government, and that is being reflected in the currency. So you've got this trade-off between fiscal pressures, which are leaning towards a weakening yen, and monetary policy, which is leaning towards a strengthening yen. And at the moment, they're sort of cancelling out, and you've got a yen which is proving to be pretty sticky at about that 160 level. And finally, on South African inflation came out last week. It surprised a little bit on the downside, came out at 4.5%. I would suggest there's a bigger story underway here, and that is that if you look at the difference between South African inflation and global inflation over the past couple of years, that gap has been a lot smaller than it was prior to, say, 2021, 2022. The gap was materially larger. And this is a very significant development. In part, it's come about because of the actions of the central bank. But if you take a step back, and one of the key drivers of currency depreciation or appreciation over the very long term is inflation differences. And prior to 2021, inflation in South Africa was regularly quite meaningfully above that of the global average, which would mean that over the long run, you would expect the rand to weaken quite materially too, enough to offset those inflation differences. But if the situation post-2022 persists, and that is our best case, with the difference between South African inflation and global inflation, or South African inflation and US inflation, is quite small, on the scale of 1% or so, you wouldn't expect the same sort of currency depreciation that we would have had in the past. It's a meaningful shift. We have written a bit about this before. We are going to write more in time. But should this shift persist, again, you would expect a currency that's going to be much more stable and depreciate by much less over the long run. Now, our fair value estimate for the currency at the moment is about 1650, which is roughly where it's trading at the moment. But this picture suggests more stability going forward. Just on those inflation numbers, our model suggests that inflation in SA will dip a little bit next month, but then start to pick up again, and we get to a point where it's about 5% by November. The SARB has indicated before that should it get to 5% and persist there for a little while, they'd be looking to hike. So there is still some risk of a further hike from the SARB. These numbers could shift quite materially based on where crude goes, and we will update these on a monthly basis. But in the interim, it's probably too early to rule out a hike from the SARB by year end. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.